I'd say you could fire ahead there, Ellen.
Okay, great, great. So good evening, everybody. You're all very, very welcome to our financial planning for retirement evening. My name is Ellen McElroy. Many of you have come across before. For those of you that don't know me, I'm one of the regional managers here in Irish Pensions and Finance, and I'm going to be your compare for this evening. I'm joined by my very esteemed colleagues, Neil McGroarty, Senior Financial Planner and Regional Manager, and Wendy Thompson, Senior Financial Planner, and I suppose experts in their field and with the company a long time. And I'm going to talk about them a little bit more in a while. Before we get to the content of the evening, I just want to talk to you all about what we're hoping to get out of this evening. Now, we've been doing these retirement seminars since 2010, Sarah, I think at this point.
So a long time, Ellen.
a long time. And we're up and down the country in hotels dotted around the country. And look, there was always limitations to the numbers we could provide for. Now, COVID put a bit of manners on us, and we found that by running a webinar, we can facilitate everybody up and down the country. And equally then, recording the content allows those unable to attend to digest the information. So look, our main objective for all of us here is to present the information so you can decide what's important for your own retirement. It's not one size fits all. Everybody's needs, wants, and aspirations are different in the run up to retirement, at retirement, and after retirement. And look, the decisions you make at this point before you get to retirement can have a massive impact on the rest of your life, essentially, you know. Look, before I introduce our key speakers, I just want to outline a couple of little bits of housekeeping. Webinar should last about an hour. You know, unless I start telling some of my jokes, then it might be like 1:15, but I'll try and limit the jokes, folks. Look, we do encourage you to take some notes. We will be sending you a copy of the slide deck, but it is important that you focus in on the areas that are important to you. Not everything here tonight is going to be relevant, but you may get that light bulb moment during the webinar. Go, look, actually, yes, that's important to me. I need to look into that a little bit further. Or actually, I never thought about that before. I need to explore that option. We've had buckets of questions, Sarah, haven't we? And they've been flying for the last couple of weeks. And it really is great because it means we can kind of focus the webinar around the questions you're asking us. And a lot of similar questions, a lot of really interesting questions. And what it really tells us as well, folks, is that there's a good bit of uncertainty around what happens in the run up to retirement. Hopefully we can deal with a lot of those questions. We may not get to all of them, but what we do find is that the slides cover a lot of the information as we go. Okay. So I suppose, look, the chat function, it'll be off for the main bulk of the webinar, but we will let you know when this is off. We just want to kind of get a little bit of interaction with you. And also as well, we have a competition, Sarah. Very, very exciting.
We do indeed, Ellen. Yes, so we have a €100 one for all voucher available. So the idea is that we will have a snippet of information coming up during the webinar. So eyes and ears peeled, and we'll ask a question at the end, and it'll be fastest finger first into the chat function. So we'll pick out the winner then at the end.
Yeah, excellent. And equally as well, guys, again, just to refer back to the light bulb moment. You're going to be making your notes. You're going to be, you know, looking at what's important to you. There is a QR code on each of the slides that our lovely Sarah has put on each of the slides in the slide deck. If you do get that light bulb moment, get your QR code out, fill it in. It'll come straight into us and we can set you up with an appointment or a screening call with a financial advisor to see if this makes sense. I just want to also thank first and foremost Sarah Connolly, our marketing manager and producer, who put all of this content together. Who actually puts everything together for us, to be honest, and IPF would probably close down if Sarah wasn't there. She does an excellent job for us. And fun fact about Sarah, you'll often see Sarah roaming around the streets of Clonee with her French bulldog up and down the streets trying to walk him. And also as well, she does a mean version of Valerie at karaoke. So absolutely, if you ever come across Sarah singing, you're in for a treat.
I won't give you a rendition now, Ellen. I might malfunction Zoom, but maybe at the Christmas party, you know.
If we have time left at the end, Sarah, you never know.
Absolutely.
And I'm sure everyone attending here tonight will be sung into retirement with bells and whistles on. So there you go. Great. Okay, so look, let's get going, folks. Without further ado, I'd like to introduce our first speaker for this evening, Mr. Neil McGroarty. And Neil, this is a kind of a slide deck that we use to kind of get people thinking and get a bit interactive before we get into the content of the evening. So I suppose, look, why do we save for retirement, folks? So for 1 in every person retired today, there are 6 working. Now we're going to open up the chat function for this. Neil, you know the answer to this, so please don't jump in and give away the answer. In 2050, how many people will be working for every 1 person retired? If you want to pop your answers into the chat box there, just to make sure that it's working. So 3, 2, 3, 3, 10, 2, 3, 4, 3. Great. So, and our survey says 2. Okay, so what does that tell us, folks? For every 1 person retired today, there are 6 working. So 6 people working to support that 1 retiree. In 2050, it's 2 to 1. What does that tell us from a dynamic point of view? There's going to be more pressure on the pension system in general. Okay, life expectancy has greatly increased. How many years do you think the average person is expected to live after they retire? So Paula comes in with 20, Sally on 20, Don 20, Regina 20, Brian 20, Paul 20, Emma 20, Anya 20, Pat. Our survey says 20, so bang on. So again, look, as we know, the expectancy is that we're going to live longer. There's more pressure on the pension system in general. Hence, what does that mean in the grand scheme of things? More funding is needed, okay? We move on to our last survey. So what percentage of your salary will revenue allow you claim tax relief on through pension contributions at age 60? So pop your answers into the chat box there. So 30, 40, 40, 50, 40, 40, 50, 40, 30, 40. Okay, and our survey says 40%. So very, very generous tax relief allowances above the age of 60. And I suppose it's kind of pro-rata in the run-up to retirement. So again, very, very generous reliefs available through pension contributions. And tagged on to that, I suppose, the pressure on the pension systems in general. So that's great. That's just to kind of get the juices flowing and get you thinking, folks, in relation to the content of this evening. So Neil hates me talking about him, but I'm going to talk about him anyway. He's with us a long time. He's with us for 12 years. Mm-hmm. And he's extremely experienced in financial planning. And a lot of you here tonight may have had dealings with Neil over the years, and a lot of you may be his clients. He manages a big region also, as well as managing his client bank. And, you know, he does a really, really good job for IPF. But look, fun fact about Neil. Neil, you got a bit of an interest in this business at a very, very young age. Do you want to talk to us about that?
Yeah, Ellen, I think what you're referring to there is I was selling life insurance policies for Irish Life as a referral when I was 7 years of age. Is it?
So you got the grow for the business from 7 years of age. And did you get any referrals, Neil? Were you effective?
Yeah, like anybody that had children, I was referring them on to the Irish Life representative, and he's gone around collecting his pounds with a satchel. So yeah, look, I was meant to be.
You got your calling. You got your calling, Neil.
Exactly.
I'm delighted it's worked out well for you. So well done. Brilliant. Okay, so Neil, I suppose, look, we're gonna have a conversation around building a financial plan for your retirement. Okay, so I suppose, look, for anybody sitting here tonight, and I know a lot of people here have already had buckets of reviews over the years, or you may have AVCs, or you may know what this means, but what does building a financial plan for your retirement actually mean?
Okay, thanks, Ellen, and good evening, everybody. Welcome along. So I suppose building a financial plan, from my perspective, would be understanding somebody's individual's needs and objectives, and how we go about that is conducting a fact find. So from the fact find, we'd establish someone's personal circumstances, someone's financial circumstances, finding out what their objectives are, what the important things in life are for them, seeing what they have in place, and seeing are those objectives going to be met. If they're not, then us looking at suitable plans and try and get them to their objectives, whatever they may be.
Brilliant. So Neil, like, I suppose, look, an objective. I mean, you know, I pretend I'm doing this for the first time. What do you think is an objective? Like, for anybody sitting here tonight, what could an objective be?
Okay, so like I suppose a lot of people here tonight, one key objective, which I would see a lot in practice, would be somebody with an aspiration of retiring early on.
Oh, yeah.
So somebody who's sort of, they might work in a sort of a high intense environment, for example, a physiotherapist, for example, and they don't want to work very late in life. So they want to give themselves the flexibility of knowing that when they want to retire, they can, so whether that's at 55 or at 60 potentially. Or if they want to work on, they can work on because they've chosen to do so, not because they have to, because they've put together the plan to be able to do it.
Right. So you would talk to clients day in, day out. Look, my objective is I want to get out a little bit early. What do I need to do that? Okay, very
Exactly,
good.
exactly.
Give me another example of an objective again, just you
Another
know.
one I suppose we'd see a lot in practice would be, let's say the kids going to college in a number of years' time and they haven't necessarily got a lot of savings there at the moment, and they're thinking, okay, I don't want to borrow for that because I'm going to have to pay a lot of interest. So again, putting together a strategy, looking 8 years, 6 years, 5 years, whatever it may be down the road, and putting together a plan to try and make sure that that objective is going to be met when that needs to be realised.
Brilliant. So you hear a lot of this kind of financial talk, my goal, my objective, but it's really what you want to see happen and how do you get there, the steps you take. Brilliant. Okay. Now, look, we've buckets of questions now. I'm going to bombard you a little bit with these questions and I definitely won't get through them all. Anne-Marie from the HSC is looking for information on retirement benefits and taxation. So can you talk us through this pie chart and what does it mean for anyone sitting here this evening?
Okay, so from Anne-Marie's perspective, I suppose the taxation part we'll maybe discuss a little bit later on, but from sort of like benefits that Anne-Marie would have from a retirement benefit, there'd be an income, which would basically be called a pension, and there'd be a lump sum, which is a once-off payment, which would be received at the day of, which would be calculated on the date of retirement, paid a couple of weeks later. But also when an individual is working, they'd have things like an illness benefit. So if they're off for a period of time, they're paid up to 3/4 of their salaries as a sick pay benefit. Things like death in service, so that'll be like a lump sum that'll be paid to an estate next of kin. You know, the lump sum is pretty much the death in service benefit. So when you retire, you're receiving your benefit that you wanted, but if that sum is going to be there in some shape or form for your estate, God forbid if something was to happen, and also like a residual pension for beneficiaries as well. So I know some ladies had the option of opting out of it at an early stage in the 80s, maybe early 90s. But the majority of people on the call tonight would have what's called spouses and children's in place, which is a pension for their spouse and their kids as long as they're full-time dependent.
Okay, so these are all the benefits, I suppose, under the superannuation scheme as it stands now. And some of them are benefits we're going to get, and some of them are in the event of type thing.
Exactly.
Okay.
Yeah.
Neil, just I suppose as an expert, you're doing this a long time and you're dealing with retiring people and putting plans in place all the time. Like out of this slide, I mean, what would you feel would be the most important piece of this pie?
It's a good question, Ellen. And to be honest, I think it's the income, okay, which is basically your pension, because that's going to be the bedrock and the backbone of what you're going to be able to do for the rest of your life. Okay. So as long as you've got enough of an income to be able to support you and be able to allow you to do the things that you want to do, that, in my opinion, would be the most important thing. Okay,
so focus on the income, pays your day-to-day, your bills, your food, your shopping, etc. And maintains your lifestyle. Okay, great. So look, we'll move on. Loads and loads of questions around PRSI category, and this can be a little bit confusing. Rory asks, okay, currently he's on PRSI Class C. What should he do on that in retirement? So,
well, it's a difficult kind of question, maybe the way Rory's asking that, where like when you're working, you're paying an RSI stamp of a D or B or C. And that would typically be for somebody who would be in public or civil service before April 1995.
Okay.
Post April 1995, everybody else typically would be paying an A class of PRSI, which would then generate an estate pension. So maybe in Rory's case, it might be a little bit different, where Rory might be getting a full pension from his employer when he retires. But for other individuals on this call this evening, they might be waiting until they get their state pension to actually receive their full pension.
Okay, so Rory gets all of his from his employer, whereas somebody comes in after 1995, gets a little bit from the employer, but qualifies for a state pension. Now, Neil, why would that be an issue for anyone sitting here tonight? Or is it an issue?
It can be for some people, to be honest with you, Ellen, and it could create what's called like an income gap in someone's retirement. For example, let's say what I spoke about earlier on, let's say somebody who has aspirations of retiring early from work. They might be in their 50s, might be in their early 60s. But with state pension age moving forward a little bit, that can then really create this gap. I think we have a slide on it here. So if you look at an example of €50,000, again, if you're full service, and again, if you're on the B rate or D rate of PRSI, effectively that individual will be getting half their final salary as an income. But where this could be impacted is somebody who's on the A class of PRSI, is that it's only 10,500. So the majority of their income then, from a pension perspective, is actually coming from the state, which again, I know we'll talk about a little bit later on, goalposts have moved a couple of times on that.
Yeah, I mean, if you look at this graph, I mean, it's very straightforward to understand. But you know, if you look at, I suppose, the average civil servant salary, 50,000, and and this is assuming a full service, Neil. You know,
Correct. Yeah, yeah, yeah. Good
you're
question.
dropping to almost a fifth of your income if you're on the particular A1 stamp that we're talking about.
Yeah, yeah, there are other benefits which may come in at a later date and stuff, but again, just using this particular example, that could be a circumstance where which could present. Yeah.
Okay, okay. So again, look, just again in your experience, I'm just back to the service. I mean, I've loads of questions. Claire from the HSC asks, what's her entitlements? What's her weekly pension? Scott from the HSC asks, what will be my monthly income when I retire? I suppose it's like throwing a dart at a wall at this point, Neil, is it?
Pretty much, yeah. And again, for every individual, for Scott there, for example, I would say get advice, Scott. Speak to a financial planner, conduct a fact find, let them do the analysis and trying to find how many years, or you yourself find how many years of service you have. And from us as both experts, we'd like to think to an extent we're experts in the field. We'd be able to give you some sort of a projection of what your benefits are going to be. From there, then we can then make a plan if needs be, if we feel it's not going to be enough.
Okay, and again, look, you know, service is a huge thing. You hear about it all the time, but in your experience, again, out of the people that you'd see on a weekly basis, what are roughly the percentage of people that don't have full service, would you say?
It's a good question, Ellen. And to be honest with you, over the years, it's got less and less and less. Like a couple of years ago, let's say 10 years ago, for example, we would see a lot of people who have more or less full service. But I suppose life has moved on a little bit, and a lot of people have worked in other practice and private practice, or worked abroad, or like, you know, and because of that, the amount of people we see with full service has actually reduced a lot. At the moment, we're sort of seeing around 7 and 10, a little bit with full service, but that percentage is getting less and less, I suppose, as life has moved on a little bit. Yeah.
Okay, and look, we're going to talk to Wendy a little bit later about what could prevent you from getting to full service, or why there may be some shortfalls down the line. Okay, so we move on. I mean, Anna from Cork is asking, if I retire at 60, I receive my council pension. Obviously, Anna works for council. Do I receive my full lump sum?
It's a good question, as long as Anna has her full service. If Anna has a full service, then yes. Again, this example we have on the slide here would be a salary of €50,000, and assuming there's 40 years of service. So that would be a lump sum of 1.5 times the final salary. But if potentially Anna had a reduced service, so for example, she'd half service, she'd receive half from the local authority, say. Now, she does have avenues of being able to supplement that and bridge that gap. And something Wendy will chat a little bit later on around AVCs. It is a very, very good channel, to be honest with you, if you're going to be short service, maximising the tax-free cash. There's other reasons why as well, but that can be one to maybe answer Anna's question that might sort of help.
And contrary to what we're asked all the time, Neil, do you get your lump sum once a year?
Fortunately not. No. The pension obviously is an annual payment once a year, but no, it's not, fortunately, no.
It would be nice. It would be nice. But look, it is a nice part of retirement. It's a big lump sum you receive. It's like your golden handshake when you retire. You put in the hard yards, build up your service. David from Wicklow has a good question, Neil. Is there any circumstances in which the lump sum is taxed?
It's a good question, David. And to be honest, yes. Okay, technically, it's unlikely to a lot of people we would see maybe, but where you would see it potentially is, say, like a hospital consultant or a judge, and they have quite a substantial salary. And if they've 40 years, they get 1.5 times their salary as a lump sum. And if it's greater than 200,000, the first 200 is tax free. Anything above that's taxed. But the majority of cases we would see, it's 1.5 times up to a limit of 200 grand, completely tax free, David.
Okay, so for most of us, we're not going to have that kind of an issue, you know. Okay, great. So just, I suppose, on taxation then, Claire from the HSC asks, look, is her weekly pension going to be taxed at the full rate?
Yeah, Claire, it's a good question. And to be honest with you, I wish I could give you the direct answer, but what I can say is that there's two certain things in life, and taxes are one of them, okay? But where I would see a little bit in practice, we can help in relation to making sure that you're drawing your income down at the most tax efficient way. For example, depending on your circumstances, if you're married, depending on your level of income, you might be able to claim an exemption limit. But in the majority of cases, like in all cases, pretty much, the majority of cases, there will be some tax, but where you would not is if your income was less than €18,000 per year if you're single, or €36,000 per year as a joint income if you're married, and there's one individual older than 65.
Okay, so look at what this demonstrates in this slide is that actually, the exemptions are quite generous when you get to retirement,
Yeah, yeah.
Okay, great. And is there anything else, anyone sitting here tonight needs to consider around taxation just from this slide?
Yeah, like again, to quote a guy we work with, there's a sort of a scenario we'd say sort of the Goldilocks scenario, Ellen, where it would be somebody who's working in say the health service, okay, and let's just use the salary for me to work this out, say 70,000 euro. So while working, they're earning 70,000 euro, and they're paying 40% tax because their income is above the rate of say 50,000 per annum or 42,000 per annum. As they're funded to a pension plan, if they're funded to, they'll be receiving 40% relief. When they retire, even with full service, if the best case scenario, they have a 35,000 pension, they'd be able to draw income down from a pension fund at the lower rate of tax.
Okay.
So it's like the Goldilocks approach of their of the scenario. So that can work quite well, and something we see a lot in practice too, where people are utilizing that channel.
So it's not too hot tax, not too cold tax. It's just right.
Just right.
Just right. Perfect. But it's a really, really good point. I mean, in our experience, we usually find that, most people when they retire, even if they have full service, they jump down a tax band.
Typically, yeah.
It can be a lot more favorable. Okay, great. So I have a question here. And again, this is linked to, I suppose, the benefits attached to the superannuation scheme.
Mm-hmm.
Denise from DCC asks, she doesn't have spouses and children pension. Okay,
Mm-hmm.
so probably what you mentioned earlier, Neil, where you could opt in or out for those.
Mm-hmm.
What benefits apply if she died in service, but also like in retirement also, is that going to be a worry for her?
I suppose in Denise's circumstances, like she would be a little bit different to say a typical scenario where somebody is paying the spouse and children's plan. And if they're paying the spouse and children's benefit, there's a pension there for their spouse and their children, as it says, up to as long as they're financial dependent. But if she's not, there's no pension paid to her spouse, or there's no pension paid to any financial dependents. Okay. And in Denise's case, if she does want to have some form of cover for a loved one or for somebody that she might want to leave money to, she would actually need to take out a private plan.
Okay.
So private life insurance plan that she can have up until the rest of her life if she wants, if she had it on a whole life basis, or a plan that she might already have in place that she might have the conversion option on potentially. But what I'd say is Denise's circumstance, because she mightn't necessarily need anything at all. Get advice from a financial planner, Denise, and then assess whether, okay, do I need to do something? Do I not need to do something? And that decision be yours.
Yeah, I mean, we would get this a lot, Neil, I suppose from clients every day saying to us, look, I already have life cover, I'm fine.
Yeah.
What are the things that anyone coming up to retirement they need to look out for when looking at their life policies?
Yeah, like there's a good few things, to be honest with you, Ellen. And I suppose one I've seen a lot in practice recently is people carrying a lot of life cover into retirement. But what it's doing is it's basically adding to the estate. And adding to the estate, what I mean by that is that they've life cover, they've got cash, they've a house, they've all these other other assets that are building up. And then when it comes to the transfer of assets, when they pass away, that could trigger a potential inheritance tax liability. And if that is the case, then they're sort of paying for a benefit that is going to get a third of it's going to get paid in tax on it to a beneficiary. So, but in some circumstances, again, I know I'm sort of going around it, but it could make sense to keep cover there. So again, what I've seen recently, somebody who has a long-term financial dependent, they have a child with special needs. So they want to make sure that there's something there for them.
Yeah.
But on the other side, if you have the assets, you don't necessarily need to pass any life cover on to another beneficiary. Might necessarily need that.
Yeah, because that was one of the questions that Sean from the Defence Forces asked. He was asking ways of minimising inheritance tax. So that's probably a good tip there. Have a look at the life cover, as it would be a big payout if something happened.
Yeah, exactly. Yeah, and it could be adding to the estate. Like life cover, I suppose it's very individual, to be honest with you, Ellen. And you find so many circumstances are different. Like to use mine, for example, like I'm 38 years of age, I have a 9-year-old daughter, and like my say earning potential over the next 21 years, I'd want to make sure that there's money that'll be paid to loved ones if that happens to me at this stage now. But later in life, like when she's off the payroll, hopefully I'm on her payroll and there's other money coming in. Do I necessarily need that? And then at that stage of life, it's very individual. So again, going back to the point, I suppose it's going to be quite a common theme. Get advice, speak to a financial planner, find out exactly what you need, find out what you have, and put something together if needs be.
When is a good time to look at this?
I would say straight away,
Okay.
because it's based on your current life cover, is based on your health circumstance at the time you apply. So, you know, the younger you are, the more likely you'll be in better health, to be honest. So, and again, it's priced at that time as well. So if you're taking life cover out at a later in life, you maybe have other health complications. They might even give you cover sometimes, you know, that we would find. So the earlier the better, I would say to everybody.
Great. And some policies may have a medical free conversion on it, that if you do need to extend it out, that might be an option, but it's to kind of look, the devil's in the detail, I suppose.
Exactly, Alan. Exactly. Yeah.
Okay, great. Thanks for that, Neil. So I suppose moving on, buckets of questions about this. Absolutely buckets of questions. But I suppose just can you explain and go through this slide with us? And the contributory state pension, I suppose it's such a grey area, you know, and it's the bit really that we can't control, Neil, to a degree in terms of when it's paid, and you know.
Yeah. There's been a lot of changes over the years, to be honest with you, and so a lot of governments will sort of dictate that as well, what's happened with it as well. But the latest change is that you can defer your pension, so you can take it from 66, 67, 68, 69, and 70. And the later you leave it, the more you're going to get from a state pension benefit. But I would be quite careful there, because, you know, if you take your pension a year later, you're getting an extra maybe €1,000, but you would have got 14,500 the year before. So you have to live for a number of years again to break even for the same money you've forfeited. So, you know, so it's I know it's a very good thing that they're doing. They're trying to create, I suppose, different avenues, trying to help people who want to work late in life, and but at the same time, if you're going to get the extra income, that can be down to, you know, I don't see the reason why not to.
That's it. And look back to our earlier point again, we're kind of inundated with queries about retiring early, and you know, if it's a case of one piece of income lands and we're waiting on the next piece of income, why would we defer that? And health is a big hand to play in this, I would imagine, as well.
Yeah, exactly. And what I would say to everyone on the call is get your contribution statement from mywelfare.ie and understand exactly what type of state pension you could be on track for. And there are certain criteria that you do need to meet, and we have them here on screen. But get your statements, and then you'll have an idea yourself. Okay, have I got my threshold? Have I got my stamps built up already? Have I not got enough? Can I do something about it, maybe to top them up? That's something you might be able to do. But if you get your contribution statement, they're very good, to be honest with you. They're very, very quick and efficient with their service. And it'll give everybody a clear indication of what they need to do, or are they okay? And
then the certain criteria, obviously, as we can see on this slide, you know, start picking 56, 520 weeks, and certain yearly average contributions. You have certain clients, Neil, you were speaking to me about before, that would be in certain professions that would kind of finish a little bit earlier, and then they can build up stamps. Talk to me a little bit about that.
Yeah, so like one thing I've seen over the years in practice, and I can think of one gentleman off the top of my head here who's utilising this, is he retired in his mid-50s, and he had a PRSI stamps from before he worked. He's actually a member of Garda Síochána.
Okay.
Before he joined the Guards, he was working, I actually can't remember where he was working, to be honest, but he had sort of other contribution stamps, maybe working in a shop or a bar or something. But what this gentleman's doing is he was actually withdrawing an income from his ARF in his mid-50s. I know an ARF is an approved retirement fund, something Wendy will explain shortly. But he's withdrawing money from this, okay? It's generating what's called an S stamp of PRSI. So he's paying a contribution stamp. And what that means is that when he reached state pension age, he's now after qualifying for a state pension. Also, to sort of double down on this, and this is where it's worked very well, this individual is actually taking out enough every year to do this, but also his capital value of his approved retirement fund is actually above what he put in originally. So it's really making his money work for him. So
he's using the asset to build up another form of an asset in terms of the state pension. So in that scenario, Neil, he'd have a mix of DNA.
We're not on a biology webinar. But yeah, exactly. Yeah. And S as well. So DNA S. But yeah, so he's building everything up to generate another form of income for himself in retirement. Okay.
But I suppose back to the previous point, that again, it's really, really crucial that, you know, somebody like yourself could give the advice on that particular area to see if it works. It's not going to work for everybody, I would imagine.
Exactly. Yeah. And as we said, like at this stage here, and I think what I've said it a couple of times, the earlier the better that you speak to a financial planner and get advice in your circumstances. Like, I know, just to jump on to the next slide here, something we'll see here, like if you have other benefits that are there, like we can really make them work, you know, if you get advice on them early. And we also see, you know, people scrambling at retirement where they have a pension here, a pension there, a pension everywhere. they work the UK, they work, and there's a lot of, you know, stress involved when they really need the money. But the earlier you do this, and you might be able to sort of help yourself a little bit before retirement and understand how everything works, and if you can do anything to try and generate further incomes
Yeah.
for retirement, but keep things
Yeah.
easy, I suppose would be the other thing to say.
Yeah, and I think, Neil, as well, what we have found over the years, it's really, really important that, you know, you look at all of these other pots outside of kind of the public sector benefits you've built up and look at the real value of them, you know, because,
Yes.
you know, how many times have we been said, oh, I have a pension, I'm sorted, but actually, what does it give you in retirement in real money? You know, and that's really important to look at.
Yeah, absolutely.
But look, all of these are assets, and equally on the other side of the coin, you could find that actually I have a sizable pot built up in the private sector. So actually I don't have as much of a problem as I thought I did. You know?
Exactly. Yeah.
Okay, so we're moving on to the next slide. I love this slide, Neil. Have to say. One of my favorite slides of the deck. Okay, so talk to me about this.
Okay, so this is basically, we did a survey. I know we're going to talk about it in a moment, just how we use this around the budget and calculator, but we've done a survey, and the information that we're gathering from our clients, this is sort of be an average outgoings in retirement. So what we're looking at here, so from a basic income perspective, people need at least €21,000 per annum of a pension to be able to support a basic lifestyle. Now, I know you were sort of quizzing this when you seen this first around basic lifestyle and what a basic lifestyle might involve, but
there's two things that jump out here. Okay, whatever about my food and my groceries, I can cut back on those, but I'm certainly not going to cut back on my personal expenses, clothes and hair. That gives me €23 per week. That wouldn't even pay for my blow dry, Neil. And the other thing, entertainment, that gives me €16 per week, and that wouldn't even get me a good bottle of Pinot Grigio. So
fair. Yeah.
So again, I suppose it just demonstrates I suppose the outgoings that we could potentially have, but what kind of retirement do we want? Do we want to have limitations on that? Yeah. But it's interesting, and this is I suppose, you know, coming from a survey, and this is what we're being told, but there is there's a long list of expenses there that probably, you know, a lot of us don't think about in the run up to retirement, but they still will be there when we get to retirement, you know. Sylvia is asking from St. Vincent, suggestions on how to budget in preparation for retirement. So this brings us nicely on to our next slide, Neil. So talk us through this.
Okay, so for Sylvia, for yourself, I suppose this is a very handy tool that you could use, and we're going to be sending this out in the pack. And I don't know if it was sent out before this evening, but this basically give you an idea from a budgeting perspective of what you're actually spending money on. So then you'll understand how much do I actually need. What I would say is, though, is a very, very key point here is do something for 4 weeks where you track this and go through it properly. So using our sort of tap on our phone and a card, you can really track it from your bank statement. Instead of taking out cash and paying for something, you'll have a very clear understanding of what am I actually spending money on.
Yeah.
Now, it mightn't include certain things like direct debits or sort of yearly subscriptions and stuff like that. So you need to break that down. But you'll have a good understanding of, okay, what am I actually spending my money on? And sometimes you're like, how am I after spending? I know when I did this myself, like I was spending €180 a month on Sky. And I was like, how am I spending? How has that happened? You know, so, and again, trying to understand, okay, do I need to have that? Or, but you have it gives us a general idea. Like, again, something I would see a lot in practice when I speak to people, how much do you need? It can be very great. Well, I think I have a half income, that might be enough, but is it really? This will give people a good track to run on where they can stress test it and they can understand how much am I actually going to need. And that could be basic as well. You know, you might want to still have the other income coming in to still save a few bob, be able to go on the big holidays and do the things that you want to do in a long-lasting retirement. And
that's it. And what we find as well, Neil, you know, I suppose back to your point, the devil's in the detail, and to get forensic about it. But we do get feedback from our clients that actually the first 10 years of retirement, maybe your more active years, you know, so when you're doing your good bit of travel or whatever. So again, all that has to be budgeted for and planned for. So this is a really good tool to use. So Neil, thank you so much. We're going to bring you back in later on, but thank you for all that information and for those tips. So again, I'm just going to go through a couple of slides, guys. Again, this is just to get the juices flowing and to get you thinking in relation to the content this evening. But look, a recent survey has revealed that 1/3 of people approaching retirement are concerned about how they will spend their time after retirement. So this was carried out by the Retirement Planning Council of Ireland amongst the over 50s. And it revealed the concerns of this age cohort in relation to their later years. And a number of themes emerged from the responses that we got in, including feeling like they don't have a sense of purpose, financial concerns, and a difficulty with the lack of structure. So we go to work, we have a structure, we come home, we have a structure, but when we retire, that also requires a bit of structure. The majority of participants agreed that lockdowns during the COVID-19 pandemic provided some insight into what retirement might be like. So we're sitting at home, we're in our rooms, we're in our yoga pants on Zoom, whatever it is. And this may be a driving factor for pre-retirees who have changed their plans. So myself, Wendy and Neil can all, advocate that we are inundated with people that after the COVID pandemic that have changed their plans, moved their retirement dates forward. And when asked what lessons they had learned during the pandemic that might help them better to prepare for their retirement, they emphasised the value of social interaction and everyday routine. So again, back to Neil's point earlier, to have a plan, no matter what that is, be it social, be it financial. So look, this little slide demonstrates that I like to think of myself in my little plane flying towards my retirement, and my luggage there in the back of the plane is packed full of mortgages, creche fees, school fees, cost of raising the kids fighting in the back of the plane. And hopefully along the way, the kids will get the hint and parachute off the plane, and hopefully the debt will parachute off the plane. But my luggage gets a little bit lighter, but I still want the basics and a few nice things in my suitcase. So look, what kind of journey do I actually want for myself in the run up to retirement? Do I want a smooth journey with very little turbulence along the way, or landing exactly where I want to land? Or do I want an uncertain journey with a lot of bumps along the way and I land way off target? Okay. So look, again, we're going to open up the chat function for this, Sarah. Just again, to kind of get you thinking a little bit about your own retirement. So this was a survey done by businessworld.ie in conjunction with Standard Life. And they threw this out to, 1,000 members. What does a good retirement look like to you? So pop your answers into the chat box there, please. Be any answers coming in there? Being healthy, having choices, time with family, active travel, healthy travel, socialize, financial freedom, no financial worries, healthy, active, living on less, no mortgage, good, relaxation, travel, good health, income as close to possible now, travel, enough money to live on, freedom, time to do all the things you don't have time to do, maintaining a good standard of life, financial comfort, enough income to travel, healthy, no work, love it, Gabrielle, ideal. So let's have a look at what our top 5 answers were. So number 1 was financial comfort. So again, that just, reiterates what a lot of people are saying here tonight. Financial comfort, being able to do the things we want to do, travel, going for dinner, coffee, a lot more hours to fill during the week. I find I was off the kids last week, and I know I went through a lot more money when I had a spare time on my hands. And I suppose have a think about this from your own situation. Number 2, financial security. A lot of that here tonight as well. Financial security, really, really important, covering the essentials. And as we all know about the cost of living, covering the basics, we spend a lot more time at home. But our expenses, as Neil was referring to earlier with the budget calculator, a lot of them will still be there tomorrow. Hopefully our kids are gone at that point. Hopefully our mortgage is gone at that point. But we still will have, I suppose, a standard of living that we'd like to adhere to. Number 3, looking after the family financially. So, bring the kids on holiday, gift the kids money. What does this mean to you? And a lot of people like to be able to look after their family financially with the monies that they built up over time. And then number 4, spending time enjoying hobbies. So whatever that may mean to you, that could be going back to college, that could be, building on your handicap, but using the time to replace, I suppose, the time you spent at your career, whatever it is you want to do. But what we do find is that, that does need a bit of a plan. So again, just to start thinking about that. And last but not least was having a strong overall sense of purpose. So again, feedback we get from our clients, folks, is that your identity is very often tied up in your occupation, and you have a certain status in work, certain relationships, and you have a body of people around you. That will then stop when you get to retirement. So again, having something and an overall strong sense of purpose is really, really important. And that's just something to put a bit of thought into from a psychological point of view. Interestingly enough, bad retirement was a question that was posed. Top 2 answers were poor physical health and being financially strapped. So again, if you flip the coin on the other side. So I suppose, look, again, just to get the thoughts flowing and for you to think about it from your own situation, what will you need to fund for when you get to retirement? Be it, I suppose, your family, do we need to pay off property or invest in a property, insurances, my pension fund, how does that cater for myself in retirement? Is my health good? Do I want to travel? Do I want to go back to college? Do I still have to pay for kids in college? And do I want to go on a second career? Again, we've loads of clients that retire and then start to work again in another field, or they do a bit of voluntary work. So again, what is important to you? But this is all something we really encourage you to think about in the run-up to retirement. That's enough about me now. I'll stop the waffle and I'm going to introduce you to Wendy Thompson, who's one of our senior financial planners. And again, Wendy doesn't like me talking about her in a positive way. I more slag her most of the time, but Wendy's with us since 2015 and does an excellent job for our clients. And some of you are probably here tonight. But look, fun fact about Wendy. Wendy has a mini zoo in her house. Okay, so she's 2 cats and she has 5 dogs. All right. And Wendy is an only child. And when she moved out, her parents missed her so much, they replaced her with a ginger dog. So you were gutted, Wendy, weren't you, at the time?
Thanks for that, Ellen. Yeah, still getting counselling, and thanks for bringing that up.
Well, hopefully the dog won't inherit everything, Wendy. That's
yeah, exactly. Once I'm still written in the will, that's all that matters.
Brilliant. So Wendy, look, thanks for joining us this evening. So we're going to have a discussion around making the most of your retirement income. Okay, so again, look, talk me through what this slide means.
Yeah, okay, so this is, thanks again, Neil, you gave me a lot of segues to talk about here, by the way, so appreciate it. Yeah, so the retirement glide path process, this is something that we established a number of years ago, which we find works extremely well with people who engage in the process, okay? Ultimately, the objective of this process is to get an understanding of the key considerations that people have to consider before retirement, at retirement, and post-retirement, so after retirement.
Okay.
So just as an example here, if we even look at the phase 1, okay, I know, Neil, you were asked earlier on, is it ever too late to look at something, in terms of retirement planning? Well, no, it's never too late, okay? But sometimes you mightn't get to where you want to be had you have looked at it earlier, okay? In the first phase of the pre-retirement area, what we do is we give you an understanding of what you're on track for with work. As a pension, which Neil alluded to earlier, the income, the bedrock of the type of retirement that you're going to have. And we look at the options of maximising any tax reliefs that you can, because you can only do this before you retire.
Yeah.
So if there's anything that you can claw back, we'll show you the options to do that, but it has to be in your interest to do it. And that's something that we'll map out with it at a one-to-one basis.
Okay, so I suppose that kind of answers, Frank from Cork was asking what financial actions should he be taking to prepare for retirement. So I suppose that links in with your phase 1 then, Wendy.
Phase 100%, yeah.
Brilliant. And that's kind of when, you put your plans in place, you build them up, and then you get to phase 2, which is you're at retirement. So look, again, I suppose this answers the question. It's Kate from the Department of Agriculture. Do you recommend a consultation with a financial advisor prior to retirement? Probably the answer is yes there.
100%. Now, she may not need to do anything, or she may find out, look, there is something that she can do. A lot of the times, Ellen, I meet people that think that I have all the boxes ticked, I'm completely fine, and they find out some information. I suppose we know all the little nooks and crannies in terms of revenue rules and what you can be exploiting before you go, and that's where our expertise come into play. And
Yeah.
this is where we want to empower our clients to make the right decisions for themselves.
And I suppose as well, like Wendy, we were chatting about this earlier, is to decipher the techno waffle. You hear a lot of the jargon in the run up to retirement, and it can be quite confusing. And it's really to look at what's relevant to the individual. What do I need to be focused on? Okay, so great. So we're at retirement now. You built up the plan. You've put those plans into play. Why is it important that you look at these after retirement? Surely the job is done at that point.
Not necessarily. Well, look, you've built a plan, but it's very important. You would have done it if you had an AVC with us for a long period of time. You would have reviewed it. Circumstances change, rules change, state pension can change, your needs can change. Just using even an example, my grandparents are retired. They've had a fund with ourselves, pension fund, which I'll discuss later. And the amount of income that they took out initially on an annual basis has increased over the last number of years. They're on your general retirement income, moderate income. But like gas and electricity bills have gone up, their car insurance. And one of the biggest things, which they really don't want to get rid of, is their VHI. They've paid it all their life. And these are the things that if you have a plan in place, this is what these plans can be used for. And the more you engage in this process, the more we can help you utilize these plans.
And your nanny likes to shop, so I believe as well, Wendy. So all
that's one thing that my granddad said. I don't know how much that's going to cost me per year. I don't think I can put a figure on that.
Okay, so look, moving on, and I'm going to refer back to something that Neil mentioned earlier. Shortfalls. We love this term. And again, I suppose, look, Wendy, talk to me like I'm a 10-year-old. What does this mean for anyone sitting here tonight?
Okay, look, it's the main reason why people sit down with us. Okay, I suppose the canteen talk, as I call it. Look, have you got your 40 years? Not everyone does, and Neil alluded to earlier. We're seeing more and more people that aren't reaching those 40 years, roughly around 7 and 10. Okay. And as the schemes change, you can see a lot of people don't want to be working on to these latter years that the schemes are stretching out to. But the main reasons is they may have started working late. You might have worked somewhere else, whatever that may be, right? Or just your career, you started a bit later. Parental leave or extended maternity leave. Well, what we mean there is unpaid leave. So you get your general paid leave. It's the unpaid leave that you're not accumulating pension benefits. Okay. This is common as well, especially with people that might have went abroad with their career, working abroad, UK. I know a lot of my nursing clients, for example, would have done training years over there. And therefore they started a bit later in the public sector here. Non-pensionable employment, that would be a bit more specific, Ellen, to certain occupations. We would be able to establish that on a one-to-one basis, but I suppose my most common ones would be the likes of radiographers, medical scientists, who are paid on they get their pension paid on their basic salary and their lump sum paid on that, but they have a huge amount of income on their on-call, which they can use to maximize an additional lump sum. So
also, Wendy, they're paying a lot of tax on that extra overtime as well. So again, it might make sense to kind of have a look at ways of reducing that tax bill.
Yeah, so really it's exploiting the tax-free lump sum there with those people. Career breaks is another one, and that's where you're taking the time out. Job share and reduced hours, that's a very common one, Ellen. Between we pay mortgages, childcare costs and everything else. Sometimes it doesn't pay for somebody to be working full-time, and they might do reduced hours, for example, or just through choice they do reduced hours.
Yeah, so like I have Caroline from the HSE, just a question here. So she has been working half-time for the last 26 years. So the impact of that would be what?
Yeah, so basically it's based on your full-time equivalent. So in Caroline's situation, if she's worked 26 years at a 50% capacity half-time, she's actually only accruing 13 years of service.
Right.
So it's 13 years is counted towards the pension. So this is where the shortfall and getting the advice to exploit anything that she can to boost up those benefits at retirement.
Okay, so that's your 3-day, your 4-day, your half time, any kind of reduced hours
Yeah.
is going to eat into that service. Important to have a look at that. Okay.
Yeah. And
Retire
then the big one.
early. I'm laughing at this one. Retire early, Wendy. If we had €1 for everyone that said this to us.
I wouldn't be here, Ellen. I'd be a millionaire. No, look, I think even my own aspirations, I'd love to have the option to retire early. Whether I do, that'll be my choice at the time. Okay. But in a lot of situations, people want to retire early due to maybe the profession, physical, mental, you know, they might want the option to go early because of that. Some might want to retire due to their spouse, maybe retiring at a bit earlier. They might be a little bit jealous. And others may just want to say, I want to be traveling, I want to go and I want to do this at this age. But that can cause a shortfall in service. And this is where we can help you make sure that there's enough funds there to cater for that early retirement.
All right. So, okay, great. So we've shortfalls in service. Wendy, you're the solution builder. What are the options facing anyone here tonight?
Okay, so there's a few options. Okay, the first option is purchase back of temporary or training years. Okay, now that's actually a very good option. Okay, the basically temporary years or training years are years that you physically worked. Okay, so I'll use an example, Ellen. I've spoken a bit about nurses, right? A lot of the time nurses will have their temporary years at the start, okay, and they won't be counted for their pension. Okay. But they will have the option to buy them back, okay, and they can be counted then towards their pension at the end. Generally speaking, these are of great value, and we'll be able to tell you in a one-to-one consultation. We would encourage people to maybe look at that, see, get a pricing from their superannuation or pension office in work, and then we can go through the impact of buying it back, how you benefit from buying that back. What is the overall?
And I presume you know you get tax relief. It's good value. Yeah. It's really worth your while looking at. Maura from Garden Síochána has a question about calculation for buying back service. I presume we kind of refer to HR for that to get a costing on that. What are your comments on that, just in general?
Is this the notional service, Ellen?
Yeah, your notional service. Yeah.
Generally speaking, notional service is a lot more expensive. But again, I would encourage people, instead of maybe taking it from my mouth, you will hear it in the office, even if you get a costing yourself. The notional service can be quite expensive. But what we find more so with the notional service is it can take a long time to recoup what you've paid through a pension and your lump sum. The other thing is it may not make up the gap that you want. So for example, if you're buying back notional service, you may not make up the full tax-free lump sum because you can only buy a certain amount of years, for example. So again, that's something that we can look at with you on a one-to-one basis. But generally, we see more people buying back the temporary or training years, and then either the latter options, the purchase of AVCs.
Okay, so we're going to go into a little bit more detail on the AVCs, because obviously I suppose that's our flagship product, and then do nothing. And I suppose that's not us being smart saying that. Sometimes the best thing to do is to do nothing. Yeah. So Mary in Fingal Coco has a question. Look, very simple. Thanks for this question, Mary. How do AVCs work?
Quite simply, they go through your payroll. No hassle, okay? So effectively what happens is we sit down with you, we show you what you can be paying in, okay? So your limits, we figure out what you can afford, and then a deduction is taken from source, okay? So the payroll do it all for you. You get tax relief at source, okay? So Ellen, you might remember the SSIA plans years ago.
Oh yes, they were great.
Yeah, so I've heard miraculous stories of driveways and holidays and everything that people bought with them. The same principle applies, right? Except it's a little bit different depending on the tax relief that you're due, right? So for every €100 that you put into an AVC, if you're on the 20% bracket of tax, you'll get €25 added to the 100. If you're on the 40% tax bracket, for every €100, you'll get €67 added to the 100. So as you can see, you're recouping a lot back from the revenue and using that then at retirement to address the things that we mentioned earlier, the likes of the gap in your lump sum or the gap in your pension.
So even if you're on the low rate of tax, it's still similar rate to what the SSIAs were.
Exactly.
Back. Okay, great. So look, go through your wages, tax relief at source, and you can do lump sum payments. So this is an example, Wendy, of how you can turn 20,000 into 28,000 via an AVC. Can you talk us through what this means?
Yeah. So as I mentioned earlier, you can do it through payroll, right? There might be people today going, I should have looked at this ages ago, right? Well, you haven't lost out on last year, right? Basically, what you can do is there's limits on how much you can put into AVCs each year, and the revenue will give you tax breaks. So using an example here, let's say I'm lucky enough to have 28 grand in my bank account. I can put 28 grand into an AVC once revenue allows me to. And what will happen is the revenue will send back to me €8,000.
Okay.
Okay. Because I'm on the 40% tax bracket.
Okay.
So overall, it's costing me 20 grand to put 28 grand away.
Okay. So
That makes sense.
what happens if you don't do this, Wendy, before you get
lose
the fund?
The
You
revenue,
lose
get your
€8,000.
€8,000 in tax.
Okay, so revenue are rubbing their hands with glee and have
Yeah.
that in their back pocket as opposed to yours. Okay, okay. Look, moving on. So clear from revenue.
Yeah.
Revenue. What's the best way of using my AVC? So we've done the hard yards now at this point, Wendy. Okay, and you know, put the money aside via lump sum or regular payments. What can we do now?
Okay, so it depends on the individual, right? But if we're in the scenario similar to the previous slides of being short service, right? Both myself and the other advisors at IPF will be looking at any opportunity we can get to get you out some tax-free cash. Okay. So the first thing that we will do is we'll try to establish if there's anything that can be taken tax-free. And that's the first thing that you will do. You will take that from your AVC pot. Then you are then faced with three options with the balance. You've got option one, the ARF. Option two, purchase an annuity, which is a guaranteed income for life. And option three, the taxable lump sum. So I'm just going to touch on the taxable lump sum, Ellen, because I think we covered the first two in our following slides. It would probably make more sense.
Yeah.
The taxable lump sum is as simple as this. If I had an AVC worth 100 grand and I was allowed to take, let's just say 10 grand tax free, I am then left with 90 grand, which I go to step two and I have to choose what I'm doing with the balance.
Okay.
If I decide to take that taxable, I know my fiance would kill me because I would be giving half of it back to the revenue. Okay. Because you're going to pay tax on the full 90 grand. So you're giving back the guts of about 50%.
So all that lovely tax relief you've got over the years, revenue sucks it back up again. What circumstances would that work?
Okay, now, I suppose the one where it makes sense to probably take it is where, let's say, for example, somebody has, just using the exact same example a moment ago, let's say I only have 13 grand in my AVC and I can take 10 grand tax free. I'm left with 3 grand. It's a residual balance, okay? Not really going to light the world on fire. There, I would be taking that 3 grand tax free. So really, we try and prevent that happening by trying to get you to engage in the glide path process early on so you can build up a good fund and build up the likes of the other options here, which I'm going to discuss with you.
Great. Okay. So Grania in revenue. Revenue are loving this today, Wendy. Grania is asking, what is an ARF? Look, it's like these questions are written specifically for you, Wendy.
Great, thanks. I'll send a check to everyone that sent those in. I asked them to do it earlier. Okay, so yeah, an approved retirement fund is a continued investment which you take withdrawals from as you wish. Okay, it's very flexible. Okay, so for a lot of people, some people don't know how much they're going to need initially until they actually dip their toe in the water of retirement and actually see how much they're spending. You know, the reality tends to hit then, Ellen. But you've got flexible options. Okay, so you can pay yourself monthly, quarterly, biannually, annually. You can chop and change that as well. Okay, so your needs may change. The big thing is your investment grows free, tax-free. Okay, so like what Neil said earlier, I think, Neil, you have a client, and I know I have to sit down and do a review at my own granddad. He still can't get his head around how the fund hasn't gone down quite significantly given how much he has taken out. So that's a big thing around this option, is that you get your tax-free growth on it.
Okay, so just to give an example, so let's say we have 100,000, it's invested, you take 4% out a year or so, but the fund grows by a particular percentage, so it's replenishing itself. Ideally.
Exactly.
Okay, great.
Now, obviously, if you're taking extravagant amounts out, you know,
Yes.
the fund is going to go down. You will see it going down. But, you know, that's where the financial planning post-retirement and helping you manage that is very important.
Okay.
The withdrawals are taxed. Okay, so again, that's where we look at the famous quote Neil mentioned earlier, the Goldilocks approach. We try and help you draw this out in a very tax efficient manner. And that's where proper financial advice is really important.
Okay, now Wendy, deemed withdrawal, we're back to the techno waffle. What does this mean?
Yeah, look, we're not going to hand you pension manuals or anything like that. Deemed withdrawal is basically you have to, under revenue rules, take 4% out of the fund from the age of 60.
Okay.
When you hit age 70, it changes to 5%. Okay, so the minimum you take out is 4, which changes then to 5 at 70. But again, we'll hold your hand. If you have a fund with us, we'll hold your hand through that and guide you on what your options are.
Okay. Now you definitely slipped Niall and the HSE a few bob for this question, Wendy. Niall simply says, ARF versus annuity.
Well, Niall, I prepared a slide earlier for this. Thank you. Yeah, look, I suppose we mentioned there was the few options, the ARF, the annuity, and taking it taxable. So I'm going to talk you through the differences between the various options. Some might see, look, part of the retirement process, people already tend to know a few years in advance if they're engaging early what route they're going to take. So it's just educating you early, right? Yes. The approved retirement fund, flexible income, it continues to be invested, which I mentioned earlier, okay? You can leave it as an inheritance. So I believe Denise said earlier about the spouse and children's, that she wasn't a part of that scheme. I have 1 or 2 clients that would be the same, have a very good pension. That is very important to a lot of people, and the ARF would be passed to your estate if anything were to happen.
Yeah, and I suppose what we find with it, because it is an asset that you've built up over the years, if you don't get through the full balance yourself, you want your family to benefit from it, ideally. That's what the feedback we get from our clients. Right.
100%. Now, this option isn't allowed in reverse, right? If you engage in the ARF product, okay, you may purchase an annuity later, okay? I'm going to talk about annuities in a second. But on the flip side, if you commit to an annuity, you can change to an ARF, okay? So that's very important when you're making the decision. You know, it doesn't work on the reverse. There's investment.
If somebody has an ARF now, they invest in it now, and you know, because annuity rates aren't, you know, terribly good, but they might improve 5, 6, 7 years time, and it may make sense to transfer to an annuity at that point. So a bit more flexibility on the option.
Yeah, 100%. There's investment risk, right? So I know there was quite a few debates when I was sitting down with my granddad about what investment fund it went into when my granny was sitting there. Both of their attitudes to risk was completely different. So we had to find a middle ground. Yeah. So, you know, each person is individual, will find a place that is suitable given your attitude to risk. Yeah. And then there's the bomb out risk, Ellen. There's, you know, you're spending extravagant amounts of money and it's just depleting itself. Okay. So not having a structure in place and taking too much out on a year-to-year basis.
Okay. Great.
The annuity then is, there's no flexibility in income, right? So how an annuity works is, let's say, for example, I'm left with my 90 grand, which I mentioned earlier, okay? And I hand it over to a life company. They will agree a set amount that they will pay me per year for the rest of my life, okay? Now, the only problem there is there's no potential for growth. So you don't have that replenishing situation that I mentioned earlier, the likes of my granddad or Neil's client, okay?
Right.
The other thing is there's no inheritance. So unless you purchase an additional segment to the annuity, you pay a little bit extra, it won't be passed to your estate.
And your rate goes down, Wendy, doesn't it? And
yes,
even if you wanted, like, indexation is another thing to consider. If you wanted to kind of go up every year, there's a cost to that, isn't there, when you're looking at,
Yeah.
the annuity options.
And that diminishes then how much you're going to be receiving each year. Okay, so there's no encashment option. This is a huge decider for a lot of people. You're handing over 100 grand, 200 grand, whatever it may be. And if there was an emergency in the morning, you don't have access to it. Okay, so, you know, people might want to help out their kids with weddings in the future or whatever it may be, change the car, these bigger things that are maybe not sustainable to take from your pension. And this is where, you know, you want the flexibility to be able to do that. There's no investment risk. So that might be suitable for someone that just cannot take risk. Okay, so again, we'll explore both options with you. And the last then is guaranteed income for life. So you know what you're getting. It does what it says on the tin.
Exactly, exactly. So again, look, no size fits all here for either option. There's pros and cons with both, but again, it's to kind of look at your own situation and see which one is going to suit my situation the best, you know, and then we can build a plan around that. Great, that's great advice, Wendy, and thanks for all your input there. Neil, I'm going to bring you back in here. So, you know, we've spoken about pre-retirement, at retirement, the importance of getting advice after retirement. We've pulled the trigger on the R for the annuity, and we have all these plans coming into fruition now. And then we have our lovely lump sum. So again, we spoke about, we get a rush of blood to the head, we off to Vegas for a holiday, or we might upgrade the car, do up the kitchen. But typically we find that these pots that have been built up need a bit of structure in retirement.
Absolutely, Ellen, absolutely. And like, I suppose one thing I would see a lot in practice is what people, I've seen one or two people actually haven't done this, and it costs them a lot of money in the long run when you actually run the figures. But I'd say the first thing to do is clear debt. Okay, so you have your lump sum, clear any mortgage, clear any loans, clear any liabilities, credit card debt, clear it all, because it's interest you are guaranteed to pay. So get rid of it. Yeah, absolutely. Next thing then is, once you conduct a fact find with a financial planner and they establish your short-term, medium-term and long-term goals, being honest, it would make sense with a piece of that money that's left over to look at some form of structured investment plan.
Yes.
So again, that on the long run should generate more of a return than potentially money that's sitting in cash deposits or sitting in stuff that's sort of safe and secure.
Yeah. Yeah. Perfect. And I suppose, Neil, you know, it's really important again to consider these options. It's not for everybody, but again, it's having the time to process and then put the time aside to think about what you would like to see your monies do for you in retirement. So moving on to that, we have an investment seminar coming up on Wednesday, the 15th of May. Look, all are welcome. And again, if it's a case that you want to look at an investment, or you just want to have a look at why someone would invest in this current environment, or you just want to have, you know, a look at maybe dipping your toe into the investment world, come along and have a listen. You'd be amazed at what it might trigger within you. And if you do, ask yourself, look, how much do you have available? What time frame do you have to invest this money, if at all? And what are your primary objectives with this lump sum? So again, large pot of money for most of us. There may be other savings, there may be other, you know, inheritance pieces there that you might want to look for a home for. And will you need to draw an income from it? And what access, if any, will you need? So look, to register for the investment seminar, email webinar@ipf.ie. I would encourage all of you that have even the slightest bit of interest in this topic to come along and attend. It's a very, very popular topic as well, given, I suppose, what we've seen with inflation over the last couple of years, and I suppose interest rates in the bank the way they were. They are improving slightly, but again, it's to kind of look at your own situation. So again, if you have an interest in that, email webinar@ipf.ie. Now we're going to move on. Again, for anyone coming up to retirement, at retirement, after retirement, there's our lovely Blaheen there on the phone, and we have a retirement help desk. So we would get queries in on a daily basis: taxation on AVCs, how do you draw income on approved retirement fund, are you invested in appropriate funds, can I switch, what are your options with savings and your gratuity, i.e. tax-free lump sum, and inheritance tax liability. So again, this service is completely free and it can be used as often as you wish. And also as well, if you have any questions, we do try for the most part to put you through to a financial advisor who can answer your questions. Okay, so we're on to the fun part, Sarah.
We are indeed, Ellen. Yes. So my favorite part of the evening.
we're
So we
on
have
to
another
our-
Think for All voucher available for one lucky person. So hopefully everybody has been listening intently.
Yes, absolutely. And it's going to be a financially driven question. So fastest fingers first.
Absolutely. So we've opened up the chat function. So the question is, how many pets does our lovely Wendy have? If anyone's listening. All right, so we've plenty of people flying in with the answers there already. Well done. Obviously, all listening very intently on the start. Now, so I think our first correct answer I can see, I think it's from Brian O'Kane. So well done, Brian. So our answer is 7. There she is, her lovely, all her pets there.
Well done, Brian. It's nice to know we were all paying attention to Wendy's
That's
story.
Well
Very
done, well done.
Great stuff. Okay, so I know you're all devastated that we're at the end of the evening, folks, but I don't think we ran too much overtime, Sarah. I think we started around 6 minutes past. We're now 13 minutes past 8. What happens next? Look, if it's a case, as we mentioned earlier, you had that light bulb moment during the webinar, click on your QR code. We have a team of professional financial advisors at your service to go through any queries and book your glide path meeting with an advisor. Even if it's just a 5-minute screening call that you just want to kind of ask a couple of questions on, and we will then, you know, tease through whether you feel or we feel a financial review, a full review is going to be worth your while or not. And a lot of you may already have the answers from this presentation, but we would encourage you to engage if you're coming up to retirement or you want to put a bit of a plan together for yourself. I want to thank Sarah for putting this all together. Tireless work you do, Sarah, on a day-to-day basis. And I also want to thank Neil and Wendy for your professionalism and I suppose your slides that you put together. And I want to thank you all for coming along tonight. And I suppose really, you know, interesting things to think about. And some people think that, you know, finances aren't, you know, the most coolest of things, but it is really important when it's your own situation and when it affects you, you know, and particularly retirement. So look, wish you all the best in the run up to retirement, at retirement, post-retirement, whatever it may be, and wish you all a lovely evening. And hopefully we'll see you over the next week or so on our glide path meeting. So all the best. Thank you very much, folks. Take care.
Thank you.
Thanks, Ellen.